Hello, everyone. Thanks for watching. Today, we're going to be going over sales and purchase related transactions using the Perpetual inventory system. This is for our Chapter 5 homework on retail inventory uh, purchases and sales. We're going to go over each of these transactions, and then there's going to be an adjusting entry for the next month for December. So we're starting in November, and we have a lot of transactions to get through. So let's get started. The first transaction is purchased merchandise on account from Moonlight Company. The list price is $85,000. There's a 25% trade discount, terms FOB destination, terms 210 net 30. So trade discounts are recorded net. Um, they're not recorded in the purchase price. This is just a discount they get for volume because they purchase so much. So therefore, we are going to just record the 85,000 less the 25% off. Our journal entry is November 3rd. I'm going to debit inventory. 75% of 85,000 is $63,750. And if we look at our chart of accounts here, we have accounts payable for Moonlight Company. And that is who we purchased this inventory from, and we have to make sure to attribute our accounts payable to the right vendor so that we can keep track of who owes us what. The next journal entry is on the 4th, and we sold merchandise for cash for $37,680. So that's going to be a debit to cash for $37,680 and a credit to sales, which is our revenue account. Now we need to record the sale of the inventory and our cost of goods sold. And the cost of the goods sold is given to us at 22,600. And this is going to reduce our on-hand inventory. Purchased merchandise on account of from Papo's Creek Company for $47,500 FOB shipping point. Notice how the first problem was FOB destination, and we're purchasing it. So that means that we don't own it till we have it. We're not paying the shipping. In this case, we are paying the shipping, and the prepaid freight of $810 was added to the invoice. And so we are going to just include that in our amounts for inventory. It's included on the invoice, so we owe that to Papo's Creek. So we're going to include that in our accounts payable to Papo's Creek. So we need to get our correct liability from our chart of accounts. Our accounts payable to Papo's Creek, and that's going to be our credit. And then our debit is going to be the inventory. This transaction happened on the 5th of the month. And our total is the 47,500 plus the 810, which comes out to $48,310. Now we return merchandise with an invoice amount of 13,500, which was the 18,000 less the trade discount, purchased on November 3rd from Moonlight Company. This is going to reduce our accounts payable to Moonlight Company and also reduce our on-hand inventory. And the invoice amount of 13,500 is the amount that we are going to reduce our accounts payable by. Now we have a credit sale on the 8th, selling $16,500 in merchandise. And the accounts receivable is Accounts Receivable Quinn Company. And the sales amount was 15,600. We need our credit to sales, and then we need to make our cost of goods sold entry. Cost of goods sold was 9,400 because that's the cost of the inventory. And then we're going to reduce our on-hand inventory by the same amount. On the 13th, we paid Moonlight Company on account for purchase of on November 3rd, less the return on the 6th. So this is now on the 13th. The 13th is 10 days after 10 days after the 3rd. And so that's going to allow us to take advantage of the discount in the 210 net 30 terms provided. The 2 is the 2% discount. The 10 is the amount of days required to take the discount. And then the N30 means that the net amount of the invoice, meaning the total amount, is due on the 30th. So if we prepay within 10 days, we get a 2% discount, and that's pretty significant. In this case, we are paying the remaining amount of the invoice. To calculate this amount, we have to take the original amount that we paid for that we accrued for the inventory, which was less the trade discount. So we have our 63,750. We then subtract the 13,500, and that's the amount that's remaining on this invoice. That comes out to 50,250. And that's going to be our debit to accounts payable for Moonlight Company. Now we have to account for our discount, which is 2% of this balance, and that would be $1,005. We also have to, then the remaining balance is our cash that we paid on this invoice, and that's $49,245. On the 14th, we have a sale of merchandise with a list price of $236,000 to customers who used Visa. And we're going to record this as cash. They redeemed 8,000 point of sale coupons, and then the cost of goods sold was $140,000. These were point of sale coupons. They weren't coupons that were taken from a previous promotion. Therefore, we're going to reduce our sales in the moment. So this amount recorded for the sale is going to be the 236 minus the 8,000, which comes out to $228,000. With a debit to cash and a credit to sales. We then need to debit our cost of goods sold for the $140,000 and reduce our inventory by the same amount. On the 15th, we pay our invoice for, for Peppo's Creek. This also is an invoice that's 210 net 30. And recall that the 2 in the 210 net 30 is the 2% discount, and the 10 is the amount of days from the invoice date that the customer has to pay in order to receive that discount. And 30 means um, that if they pay after the 10 days but before the 30 days, then there's no discount. After 30 days, the invoice would be considered late. So to calculate the amount that we owe, we have to take the 47,500, and now there's no trade discount here. So we can take the 47,500, that was the cost of the merchandise. That's what we're going to take the 2% discount off of because they are paying within 10 days, so they are entitled to the discount. However, the discount does not apply to the prepaid freight. And so we take the $47,500, subtract the 2% discount, and our 2% discount here is $950. And that's going to reduce our inventory balance as a credit. And our total balance of the accounts receivable, that or of the accounts payable, that's what we initially accrued for accounts payable Papo's Creek, and that's $48,310. And the $48,310 minus the $950 discount, our total that we actually pay on this invoice is $47,360. And that's a credit to cash. Now on the 23rd, we receive cash on account for the sale from November 8th. November 8th, we sold terms with net 15. That means that there's no discount and they must pay within 15 days. So we're going to collect the full amount of the sale here, which was 15,500, 15,600 actually. And that's on the 23rd. And our accounts receivable from Quinn Company is our other account because it's from Quinn Company. On the 23rd, on the 24th, we sold merchandise on account to Rabble Company, 56,900 in merchandise, terms net 30. There's no funny business going on in this problem. It's just a simple 20, so it's on the 24th. And we need to get our Rabble Company accounts receivable balance. Amount is 56,900. Now we need our cost of goods sold entry, also on the 24th, $34,000. And that's going to reduce our inventory. On the 28th, we paid a Visa service fee of $3,540, and we're going to record that as an expense. If we take a look at our chart of accounts, we have a credit card expense account, and we're going to use that. And we pay that in cash directly. It says paid, so we paid that directly in cash. Now on the 30th, we paid Quinn Company a cash refund for returned merchandise from the sale on November 8th, and the cost of the returned merchandise was 3,300. In this case, the um, we are going to assume that uh, the company has made accruals previously to account for estimated returns, and that they record returns on a running basis where they accrue for any returns and any coupons that are going to be used in the future. And we're assuming this because uh, in the next problem, right, we're supposed to make the accrual for the coupons, and then in December we're also making an accrual for this. So we need to make an accrual for we will use our accrued accounts to record this transaction. And also in our chart of accounts, our customer refunds payable is our liability, and our estimated returns inventory is our inventory asset for this. And so for the amount returned, we paid a cash discount, we paid a cash refund, and the amount of cash refunded was $6,000, and the amount of merchandise returned was 3,300. Now so we have to make our debit to customer refunds payable because we already accrued for the refunds that are going to happen. And then a debit to cash. So we're reducing our refunds liability, and we're also increasing our on-hand inventory and reducing our estimated returns inventory accrual. Now we are going to make a accrual for the coupons issued during the period. During November, there was a $2 coupon on each receipt, and there were 20,000 coupons printed, and we're estimating that 55% of them are going to be redeemed. So $2 times 20,000, that's $40,000. 55% of $40,000 is $22,000. So we need to record a $22,000 accrual, reducing our sales for this month because these coupons were used to help increase our sales this month. So we need to reduce our sales. That's going to be a debit to sales. And then we're also going to credit estimated coupons payable, which is in our chart of accounts, estimated coupons payable. And then uh, now in the month of December, people are going to be using these $2 off coupons. And that's actually going to mean that in in November, our sales are going to be less, but in December, our sales are going to be more because even though the company, say for example, there's a $15 transaction and they're receiving only $13 because of the $2 off coupon, they're going to record $15 in sales in December because they're going to reduce their coupon payable liability and increase sales in December. And in our instructions, we are assuming that 10,400 of the $2 off coupons issued in November were redeemed. And we're going to journalize the entry for the unredeemed coupons. So now it's the end of the month, and these coupons are expiring. Um, so we're going to close out this coupon account. And this is going to be a December 31st entry because it's an adjusting entry. And 55% of 20,000 is 11,000. And so 11,000 minus the 600, there's 600 unredeemed coupons left, meaning in our estimated ones that we thought were going to be redeemed. And that's 600 times 2, that's $1,200. There's a $1,200 credit balance in our coupons payable liability because there's unredeemed coupons. That means it's a liability at the end. We have to close this out, and since there's a credit liability, we need to debit that liability in order to close it out. So that's going to be a debit to estimated coupons payable for $1,200. And then we're going to credit our sales, which increases our sales. That's all for this problem, everyone. Thank you so much for watching. And I wish you the best of luck on completing your homework for this week.